Hi guys, thank you for joining me. This is my very first YouTube channel video, And today I'm gonna be teaching you how to analyze a balance sheet, like CFO. What does a CFO look at in a balance sheet to know the financial health of an organization? But before that, let me give you a brief introduction of myself. My name is Momoa. I am a BCom holder. I'm also a member of the Institute of Certified Public Accountants of Kenya, a member of the Institute of Management Accountants here in the US. Currently, I'm doing my MBA also here in the United States of America. And I have over 12 years work experience. So without much further ado, let's dive in. So what is a balance sheet? A balance sheet shows us what we own as an organization vis-a-vis what we owe to others. And when I talk about what we own as an organization, I'm talking about the assets. And under the assets, we have two classes of assets. We have the current assets. These are assets that will be converted into cash in the next operating cycle or the next 1 year, whichever is longer. We also have the non-current assets, assets that will be held by the organization more than 1 year from now. And this includes the property, plant, equipment. The organization could be having a piece of land somewhere, probably some goodwill. Current assets, what will be converted into cash in the current operating cycle? We have the cash and cash equivalent. This is the cash in hand and cash at bank. Marketable securities. We've invested in securities to gain some interest income, which can be converted into cash very fast. Accounts receivables. We've sold on credit. We expect the debtors to pay us in the next operating cycle, and they should be reported net of provision. We know not all receivables will be paid. Some will default, so we need to provide for what won't be paid. We have inventory, the goods that we are holding in our stores to sell. The prepaid expenses. Maybe the lease agreement provides that we pay for rent in advance. So that is the combination of the prepaid expenses. Expenses that we paid for before we received the service. Let's now jump over to liabilities. Other liabilities, we have the current liabilities. These are liabilities that we will pay in the next operating cycle for 1 year, whichever is longer. Accounts payables. We've received inventory on credit. We need to pay for them. Notes payables. Accruals. We've received a service, but we haven't been invoiced. So that is a liability to us. The current portion of the long-term debt. We know long-term debt will be paid for more than 1 year, but there is the current portion that needs to be paid in the current operating cycle. Accrued salaries and 20s. We could be having salaries and 20s that we haven't been paid. That is not our money. We need to accrue them and pay them in the next operating cycle. Non-current liabilities. These are liabilities that are outstanding for more than 1 year. Maybe a bank loan with a maturity of like 10 years. Deferred tax, money that we owe to taxman, but won't be paid in the next 1 year. Also, under what we owe, under liabilities, we have the money that belongs to the shareholders. We have the preferred stock, which is a hybrid of common stock and debt. That is not our money. So that is money that belongs to the shareholders. We have the common stock. This is the par value of the common stock. and the market, the current, the market value of the common stock. The retained earnings, money that the profits that we've accumulated over time, maybe we've not used them, we've not paid them as dividends. That is what makes the retained earnings. This is not our money, it's money for the shareholders. So the balance sheet will show us the assets versus the liabilities. And the first thing that the CFO looks at is our financial statement. The statement of financial position, is it balanced? Why do we call it a balance sheet? It is to be balanced. What we own versus what we owe needs to be the same. For example, here, our total assets are $1,740,000, which should be equivalent to what we owe to others. That is the liabilities and the shareholders, which is $1,740,000. So our balance sheet is good. We can now start analyzing each line item. So let's start with our current assets, the cash and cash equivalent, the money that we have in hand, plus the money that we have in the bank. We have $160,000. That is the money that we have in hand. Do we have enough money to pay our debtors? Sorry, do we have enough money to pay our creditors? Do we have enough money to pay salaries? Do we have enough money to pay dividends? That is the first thing that the CFO will look at when we talk about cash and cash equivalent. Are we liquid enough to pay our obligation as they fall due? If not, where do we get additional money from? Let's look at our marketable securities. We've invested in marketable securities. They're giving us returns. Do we need to convert them into cash to pay our obligations? Accounts receivables. We've sold on credit. We need this money back. The first thing that the CFO will look at when we talk about the accounts receivable is the hedging schedule. How long has this receivable been outstanding? Because we know the longer the receivables has been outstanding, the more risky it is, the probability that we won't be able to be paid back. So you need to start collecting the overdue accounts receivables. How fast are we turning over our accounts receivables? How fast are we collecting our accounts receivables? That is what the CFO we look at when it comes to account receivables. Inventory. We need a breakdown of the inventory too. Are we holding more stock than we need? We have our reorder levels. Because we know there's carrying costs of holding stock. There are costs attached to holding stock. So are we holding more than we need? What is the expiration date of the stock that we need? Do we have stock that is nearing expiration? We need to cut the costs. Maybe like offers, sales offers. I know you've been to the supermarket or maybe to the store where you get an offer where you're told you buy one, get one free. We're trying to reduce our costs because we have stock that is nearing expiration, the prepaid expenses. The prepaid expenses will be expensed as we receive the service in the period when we receive the service. Let's jump over now to the non-current assets. This is the property, plant, and equipment. We need a schedule showing a breakdown of the PPE. Are we depreciating our assets according to the company policy? Are we holding assets that we don't need? What are the current use of the assets that we have? So basically that is what the CFO we'll be looking at when it comes to current assets. Thank you for staying with me. Let's now jump over to the liabilities and equity. Under liabilities, we have the current liabilities. These are the payables and the accruals. We need to pay our payables in time, but we know as an organization, the longer we hold our payables, the better for the organization. But what does the policy say? What are competitors doing? What is the industry doing? So those should be our benchmarks. Accruals, have we accrued for all the services that we've received but not yet paid? Non-current liabilities, these are the bank loans, money that we hold to investors. We need a schedule. We need to know when they are due. We need to know how we're servicing them as we should. That is the non-current liabilities. These are liabilities that are outstanding for more than 1 year. We will service them for more than 1 year. Let's jump over to shareholders' equity, the common stock, the par value. What is the authorized share? Shareholders' shares, the authorized shares. Do we need to raise more money through an IPO or maybe a secondary IPO? The retained earnings, money that we've accumulated over time from profits. So how are we using our retained earnings? Do we need to do some investments, capital investment decisions? Do we need to pay dividends to our stockholders? So basically, that is our balance sheet. It needs to be balanced. The statement of financial position needs to be balanced. Our assets needs to equal our liabilities, and we need to analyze each line item. We need to get an insight of each line item. We know it's more than the numbers. My next video, I'm gonna be showing you how to analyze different ratios for the balance sheet. We know there are different ratios that you can, different ratios that show you the financial health of the organization. We have the liquidity ratios. We have the current ratios, the quick ratios, the cash ratio, and the net working capital ratio. We also have solvency ratio, which deals with the long-term liabilities. The debt to equity ratio, what does it really tell us? The long-term debt to equity, what does it really tell us as an organization? The debt to total assets, the interest coverage, how comfortable can we pay our interest? We'll also be looking at our operating leverage. How are we using fixed costs to finance the profitability of the organization? Financial leverage, how are we using debt to finance the profitability of the organization? So watch out for my next YouTube video. That is what I'm gonna be looking at in my next video. Thank you for staying with me. Thank you for watching all the way to the end. Don't forget to like, subscribe, and share. Thank you so much.